Well, good evening, everyone. I'm absolutely delighted to have Beto with us today. Beto Pallares, I got it right. The pronunciation was a little bit difficult for me earlier on. Beto founded Joseph Advisory Service in 2006. He brings extensive domestic and international startup experience as an entrepreneur and in conducting due diligence for both startups and late-stage companies. His professional experience spans working from top-tier strategy consulting firms, co-founding startups, international business development, non-profit management, venture capital, and indeed military service. In the summer of 2009, he co-founded Cottonwood Capital Partners, the general partner of Cottonwood Technology Fund, a seed and early-stage venture fund with headquarters in El Paso, Texas. He serves on several corporate and not-for-profit boards. He is also an advisor to the UT Horizon Fund, the venture capital investment fund for the University of Texas system, and serves on and as a limited partner on the limited partner advisory committee of several other venture funds. Beto graduated from Brandeis University in Waltham, Mass. With a degree in economics and received an MBA from the University of Texas in El Paso. He also went on to obtain his PhD in international business from the University of Texas in El Paso. And I should be calling you doctor, of course, sorry, but you're so nice. His research is focused on the confluence of high-tech emerging markets and firms, incubators, and technology commercialization. He's married and enjoys fatherhood when not watching his kids while his wife is a professional photographer who happens to be on assignment. He engages in reading, writing, and community service, including service in the Rotary International and Gideon's International. I'm absolutely thrilled to have Beto here tonight because his experience actually thread through different levels of capital from the startup stage all the way to working with family offices. But Beto, tell us more about the kind of things you've done on early stage capital.
Thank you, and thank you for having me here. And it is an honor, and I'm deeply grateful for the invitation. Just a word on the doctorate part. I'm very proud of that, and but you got to take it with a grain of salt. I have a 4-year-old and a 6-year-old, both of them girls, and the 6-year-old said, "You know, Dad, are you a doctor?" And I was very proud as I reflected on 7 years of work, and I said, "Yes, yes, I am." And my 4-year-old leaned over and whispered in her sister's ear and said, "But he's not a real one." So if ever we get a little out of context, people around us certainly know how to bring us back down to a ground level. But early stage capital is an area that I'm tremendously passionate about, particularly because as someone with a doctorate degree, but not in a technical field from the perspective of an engineering or medical field or what have you, I live vicariously through people who invent stuff. I live vicariously through people who solve very complex problems that make significant contributions to a society. And a lot of those initiatives are often frustrated because of the lack of early stage capital. And so while we emphasize the inventiveness and really emphasize the aspect of taking a risk from the perspective of thinking through complex problems and finding a solution, we tend not to emphasize the aspect that complements that, which is early stage capital. So years ago when I was involved in the aspects of the Emerging Technology Fund, which I think is a wonderful, wonderful addition to the milieu of access to capital, but it is by no means the only one, and you know, it's necessary but not sufficient. You know, the idea came up is, well, we don't have a venture capital fund in my region. You know, there's a dearth of capital in general, even early stage capital in the state, and a family that we had a relationship with challenged us to come up with a model that worked in terms of deploying capital into early stage companies that had disruptive technologies, but that allowed for a, if you will, dipping of the toe into that proverbial pool and understanding whether we were in line with milestones and deployment of capital and mitigation of risk. And so we were able to coalesce a number of investors and develop a new wrinkle to early stage capital that straddled what is angel investing and a formally managed venture capital fund. It essentially was very high net worth individuals deploying capital into a venture fund-like structure, but having the ability to decide on a deal-by-deal basis whether they support that deal or not in terms of their pro rata investment rights. So we deployed a novel fund, and we launched it officially November 1st of 2009. If you remember the economy during that time, the data that was coming out in terms of where funds were, venture capital funds, noted that there were only 17 funds that raised any capital in the latter part of 2009, the last 6 months of 2009. So we're very happy that we were able to get this off the ground. And we've made some investments out of that fund. That fund is fully committed. We're very happy with the portfolio and is trailing well. In parallel, Joseph Advisory maintained its activity with respect to advising a specific investor on their early stage capital deployment. They were large supporters of this fund, and we looked at the industry and said, well, the opportunity still lies in early stage capital. Why? Because the reality is that 50% of deals that exited last year, 50% of venture-backed deals that exited last year, exited for $50 million or less, which means they're not getting capital from these funds that have $1 billion that need to make $25 million investments at a tranche or a one fell swoop. And so you have to have access to early stage capital, which means that your fund needs to be right-sized to be able to make those $250,000, $500,000, $1 million size investments and make several of them. So we developed a strategy to invest in early stage capital by investing in funds that we believe had the profile of what is commonly known now as emerging managers. So we reviewed upwards of 70 funds over the course of several years. When you think that in 2000 or so, there were roughly 1,100 venture funds. And by 2008, 2009, there were 900. And right now, by some statistics, there are 550 funds. This includes all venture funds. Now, these are funds that have money to invest that are actively making investments. There could be other funds that are tapped out or have reached the maturity level they desired. So we essentially reviewed a fairly high percentage vis-a-vis the number of funds out there. And more so, we went very specific and looked at only early stage funds. These are funds that were sub $75 million. And so to date, we have a portfolio, including Cottonwood, of 9 venture funds, and we deploy capital into those with the strategy of banking on managers that have a unique mix of attributes and characteristics to go and find early stage capital. So that's our activity.
So would you say that you're dealing sometimes with funds that might be considered super angel funds? Like not the classic angel size, but not the classic larger VC size? Is that a fair comment, or would you describe them differently?
I think it is a fair comment from the perspective that much, as in many industries, has to do with creating a moniker or a name. So I would say that a super angel fund, with respect to size, could be, I don't know, 25 million, 50 million. And that name emerged fairly recently. And it emerged, in my opinion, out of a frustration of where venture capital traditionally had significant activity, and then moved what's called upstream and raised larger funds. And so they basically said, well, this is a super angel fund. It behaves like an angel fund. But the reality is that there is a standard behavior and a standard of knowledge of how to manage a venture fund. And if it's a super angel fund and that name fits, but it's managed the way a venture fund ought to be managed in terms of all the disclosures and limited partner, general partner relationships, to me, they're either early stage funds or super angel funds. So it's a valid tag describing a common phenomenon.
And when you looked at these 70 funds that you were looking to put money in for emerging investors, Were they by territory, by location, by market? Did that make any difference to you? What kind of things were key to you?
You know, that's a good question, because at first, you know, having a desire to be as programmatic about this as I could be, I developed a matrix, and I said, how many funds do we want that are in this sector and this kind of background and this geography and so on and so forth. And then we realized that we would end up getting into this game of really just second guessing and trying to fill a covey or fill the box and say, well, now we have this fund in this area. And so we scrapped that and we said, look, the measure will be three things. It'll be you're an early stage fund or a super angel fund if you're sub $75 million, with the sweet spot being 25 to 50 million. There's some reason behind that in terms of number of deals you can make and whatnot. So let's just go by bite size. You know, you're an early stage fund. That's the first thing. Geography, we don't care. And you know, you'll find that you'll find funds that bubble up for other stuff. Sector experience, there's a lot of research out there that says, well, funds that are IT focused do better, or funds that are, you know, biotech do better, or so on and so forth. The reality is that it goes to the third area, which is, you know, no geography, but we have a sector, no geography, but we have a fund size. Experience of the manager is very key, right? And having had some investing experience or even deep entrepreneurial experience with exits and whatnot. And the third thing being, who are they surrounded by? What's their ecosystem like, right? So essentially, size of the fund, experience of the manager, and you know, the related resources that they can call on, other funds they work with, et cetera. And that made the selection process stringent enough, because you could have a fund that's sub 50, but a manager that has some experience, but you know, when you do the due diligence, you know, it just doesn't check out. You know, there's been some decisions made in a fund or by a fund manager where it's unlikely they'll be able to, you know, syndicate successfully and do enough deals.
You know, the people are always very important, given you're trusting them with the 25, 50, 75 million dollars. How do you do due diligence on those, on who effectively are going to be the GPs?
Well, you know, it's interesting because you want to do business with people you like and people you trust. You could actually like someone a great deal and not feel a level of comfort to do business with them. You can actually not like someone in terms of certain personality traits, but essentially have high degrees of confidence in their ability to both be ethical and carry out a job. The best situation when you deal with people that you like and you trust. And so the due diligence really starts with having a common understanding of, you know, do I feel that this person, you know, for lack of a better word, gives a good vibe. And we actually have a fairly thorough due diligence checklist now that we've developed over, you know, looking at 70 funds and talking to people in confidence and saying, well, what would you look for, and doing a lot of secondary research and talking to family offices and talking to fund experts, if you will, from larger organizations that go out and basically solicit fund interests and essentially diversify very large portfolios. So that checklist includes plain vanilla, give me all your legal documents. You know, how are you structured? We now have the ability, because money's hard to raise, is that we'll ask for budgets. We'll ask for budgets in terms of, I want to see, you know, you ask entrepreneurs as a fund for budgets, right? For your startups, you ask them for budgets and you want to figure out if they're going to have enough money for this or that. We want to see a budget. We also want references. So we ask for references as well, co-investors, entrepreneurs you work with, past management positions that you've filled, and people within those organizations. And then we go through a process of assessing the quality of the general partnership, because ultimately you're banking on people. Mm-hmm. And the way I look at it, to put it very simplistic, is you're essentially going into what is a 10 to 14 year marriage. And you're hoping to negotiate a prenuptial that'll end up in a very positive outcome where you invested X amount, and by the time you get divorced, you get more back, right? And if that works out, you're willing to get married to that same manager again. And so it's a simplistic way of assessing the fact that you're essentially really banking on people and the strength of that relationship over time.
As you get to see the companies within the portfolios of these investment vehicles, venture funds, do you often do any marrying or introduction or anything else vis-a-vis the companies from one fund to another?
Actually, we do and we have, and the way that happens is essentially we could be a very passive investor and we could deploy, let's say, I don't know, $1 million or $5 million into a $500 million fund, as an example. And if you do that, it's highly unlikely, because there's so many other investors and there's much larger investors, that you'll be able to pick up the phone, call the general partner, and be able to have a conversation and make any introductions. They will report to you on a quarterly basis and annually. But because the funds that we deal with are of a certain size and our investments are of a certain size, we're able to develop that relationship over time. And as we build trust in that relationship, because again, we're in this relationship for 10 to 14 years, we're able to connect the dots and say, well, I know that you need to talk to this other possible investor in your fund, or I know that so-and-so from this fund is interested. They just exited this portfolio company, and you guys need to connect. Maybe that's not common for a limited partner to do, but I am compensated based on the performance of these funds. So it's in my best interest that these funds perform as best as possible, and any resources that I have, my house is their house, mi casa is their casa, and I want them to absolutely think of me as a partner. And because of that, I think it's worked out that we serve on 4 advisory boards of these funds, because we're able to work with them across funds, and also I'll give you an example. We're also able to draw resources to help the actual portfolio companies that they're working with. We have a lot of experience in Latin America. A fund might say, we have an investment in this company, they're doing something in Argentina. Do you have a contact that we could put them in contact with? Because none of us do, and serendipitously that may happen.
So the alignment of interests between you as an LP, the GPs, and the connectivity between them sounds to be very key.
It absolutely is. My first order of business is I need to make money for my investor, right? I need to make sure that they get a return. And that kind of bar might change, but the reality is, target 20%. And so if you're investing in a fund, right, you want it to do above average, because if you're investing in a fund, you have costs, they're taking a carried interest, you're taking some portion of that carried interest, and so you still want your investor to be made whole. So the more you understand of their business model, the more they understand of what you represent and what you can bring to the table on an as-needed basis, the better.
And I think it's true to say that the venture capital category typically returns overall on over extended periods of time a 5% premium over most other categories of return, especially at the early stages.
That's correct.
As you're dealing with LPs, you're taking into the fund, super angels, you're often dealing with family offices.
Correct.
And very, very high net worth individuals. Can you talk to dealing with family offices and your experiences there?
Absolutely. Family offices are indeed very different from the vast majority of the capital that goes into venture funds, particularly very large venture funds. Really, the inflection point in venture funds happened, in the 90s and perhaps a little sooner, when pension funds and large foundations and other entities were able to deploy large sums of capital. So you had very sophisticated money managers advising large institutions on how to deploy some percentage of the capital into a high risk but potentially high reward asset category. Family offices usually emerge from deep operating business experience. They know how to make money, and they know what it costs to make money. And so they may not necessarily diversify into venture capital as readily as large institutions would. But over time, whether it be because of the introduction of a younger cohort of family members, or because they have a specific diversification need, that could be sector specific. There's some families that say, we're passionate about clean tech, So we only want to invest in that kind of area. And we know there's a dearth of capital in early stage, so we want to do that. Or they might do it for diversification reasons in the region, or they might do it as complements to a larger business, operating business they have. If someone's in the construction business, they might target LED, they might target advanced building materials. So the type of family office really varies. The size of investment may vary, but essentially what you have in terms of across all family offices is a level of sophistication in making money. They know how to do that. They may not necessarily have tremendous experience in that early stage part, right? Remember, we spend a lot of time trying to build up the entrepreneur and tell them, go and take that risk. We actually haven't spent a lot of time working with investors and saying, this is how you measure risk. This is how you kind of look at a deal like this. This is the level of patience that you need. There's another thing that's interesting about family offices. Many of them might be multi-generational. So they do know how to be patient. They do know what it takes to invest over long periods of time. And they may not necessarily care, not so much that they don't care from the eventual outcome, but they don't have the same time sensitivity that a venture fund has, right? Because if you have a financial investor like a venture fund, and they make an investment in a deal, and it's driven by a lot of institutional money, they know that they have a 10 to 14 year time period to make those investments because that's how long that partnership lasts. The family investor, they may not be part of that fund, may not have that same time constraint. And they might say, it may not be necessarily advantageous for them to leave at that point. They might want to increase their participation, et cetera. Not to say they don't think about the finance of the IRR calculation, but they're just different interests. So spending time with limited partners that represent family offices is very key, not because they don't have the level of sophistication, but because it's important to open up the dialogue and really understand what they're looking for. And the more you know of that, the better you can match them to the right investments.
I think that's a really important key point. Old traditional families in Europe would invest for decades at a time with either individuals, time and time again, or within businesses and allow them to grow very big.
Right.
And I think we're starting to see more of that now with family funds here, which is super.
I agree. And in fact, again, based on some research that I did academically, you'd find that the orientation, particularly of Asian and European families, I mean, they might make 2% a year, but they're making it over 200, 300 years, right? Yeah. It's not the same as a 20% return quarter over quarter for 5 years.
Certainly longer term plays for more meaningful outcomes.
Absolutely.
I'd like to start bringing this and making this conversation available to the audience. So please, if you have any questions, if you'd be kind enough to go to a microphone, we really would love to hear from you. And I think we have one coming up.
So Laura mentioned in the beginning that you did military service, and did that kind of training and discipline help you as far as your investor mindset goes, or do you make any connections there?
It didn't. It really is a longer story, and I'm happy to share it. But essentially, my military service was shortchanged. I joined the military right after 9/11. I worked right across the World Trade, and I have tremendously bad eyesight. And however, the value of my time spent there really played into other areas of my life that were very important. And I happen to have a very specific faith, and so there's a verse in the Bible that says, "For such a time as this." So it took years for me to realize why that experience in the military was contributing to something in my life at that point. Now, I will say where I think I have a bias, and this bias is for people that have served in the military. Not that they can't be good investors, but when you look at military training, it's very much operationally driven, and then you're driven into very specific things that can be tactical or strategic. If you're able to identify someone's strengths, sometimes because of the military service, and the military is very good at kind of identifying what your skill sets are, you're able to identify specific management skills that play very well into specific startup roles.
Thank you.
You talked about doing due diligence for the deals that you have. I understand that this criteria will probably change, but could you go into more detail into what kind of things you look for as you're doing due diligence with just deals in general?
Absolutely. And I'll give you 5 areas that to me are very important in early stage capital. First one is the market big? Is it substantially big such that you could certainly build a business that's very attractive and grow it over time? Because the point of this is not to light a match with the expectation that before something blows up or it gets acquired before then, right? It's really to build something, right? And so we spend a lot of time trying to understand the market. We talk to people from industry, we talk to people within the company. The slide that bothers me the most is when you're seeing a pitch deck is in comes the market slide and it says the market is huge. And there's no validation to how big that market is. So to me, it reflects a lack of understanding of the market size. So we want to understand it as well as the company does, so we understand what we're investing in terms of that market. The second thing is the technology aspect. How protectable is it? It's not really so much about patents. Certain industries or sectors really play into patents. Others don't. Others have to deal with how protectable it is from a trade secret aspect, or how fast you can move in the market, or it's just new and novel. So we spend some time there and we look at whether that specific embodiment of technology or disruption can be disruptive across various sectors. Because if you kind of don't get it in a certain sector, you may be able to shift it, or the timing might be wrong in a sector. The third thing is, in fact, the most important one, and that is that management team. So you really got to understand dynamics. Does this entrepreneur know how to build a business and build around people? Are they a lone wolf? Are they better off that way? So we spend a lot of time in that aspect. My rule of thumb and bias on management teams is to identify people that have about 10 years experience in that industry. Why? The reason being is, if you look back at the dot-com bubble, right, in the late 90s in particular, when you had very intelligent people that were, a few years out of college, working at prominent banks on Wall Street, and seeing all these, internet companies coming about, they would spend their nights and weekends, build a business plan, go out and raise some money, and now they were in business. Great for them, but they had no operational experience. They hadn't had the lumps in the head, right? And so 10 years experience says a lot about someone being able to do something and grow from job function to job function. It also tells me on a macro level that someone spent 10 years in an industry and they went through at least 2 economic cycles, downturns and low turns, right? And you learn something from a recession in your industry. You learn to bite your fingernails if you're, one of the last hires that could be let go, right? Because that's just the way the company works. You let the younger people go, or what have you, or they make certain decisions, right? So when someone says, I have 10 years experience in this industry, and this is why I'm starting a business that I find is disruptive in this market that I know very well, that's very big. The fourth thing I look at for due diligence is, have you built the prototype if one is merited? It's one thing to be describing an idea, a concept, but can you get it to an embodiment? And at that point, it's still an invention. All that process is an invention. The last part is someone willing to pay for it? Has someone written you a check? Has someone placed an order? Are there repeat orders, right? And so that last part is obviously pretty critical. So the due diligence process touches all of that. The legal aspect, the market aspect, the people aspect, but really those are the 5 buckets I would put it into.
While others come up to the microphone, let me ask you, when you go into an investment, do you expect to, or one of your funds, do you expect them to invest once, twice, 3 times? How many times do you have a normal expectation on a typical investment, if there's such a thing as a typical?
Are you referring to, say, a fund making an investment in company X and then reserving capital?
Absolutely,
Okay.
sorry.
So that's one thing where we think we've gotten a little more attuned to the market, right? And so while we like funds that are of a certain size, we also want to think through whether they can, quote unquote, reserve capital for follow-on investments. Because the reality is it's going to take twice as long and twice as much money, and you're going to go through some cycles of people before you actually hit a stride in any startup. It's just very difficult. As a limited partner advisory board member, or even just as an investor in funds, I get to go to a lot of conferences that are held just for the limited partners of that specific fund. They usually bring in an investment banker, they bring people from the company, and they provide a lot of proprietary data that's great because it helps form our criteria. And that's where you get the good, the bad, the ugly. And so a fund can say, look, fund one behaved this way, and fund two will behave this way, and will reserve, instead of doing $1 million investment and reserving $250,000 for that follow-on, we're going to split it in half because our knowledge of the industry, of our past investments, dictates that we do that. So remember, we want to see if the fund is of a certain size. We want to see if the management has learned something from that aspect. And that third aspect is their ability to syndicate. And there's two reasons why you syndicate. You syndicate because you might want to reduce your risk a little bit, but you also syndicate for quality. And that quality is a very unique attribute that really comes into play when you have to write a second check. What does that mean? That means I invested in a company and two other investors came along. And let's presume that I didn't know them very well, but they were excited about the technology. And now it's time to invest again in that same company. And those two other investors may not behave as kind as they did that first round. And they may read my tell like playing poker and realize that if they push the bar, I may not be able to meet the investment requirement, right? It's called cram down. And so really picking solid co-investors that you like and trust, or you might not necessarily like some of their attributes or personalities, but you trust them. And you trust the bias is to do what's best for the company, right? And so absolutely, we look at whether they can reserve capital enough to avoid some of those situations that are not germane to the company, and they're just personality issues sometimes, or strategic issues that are just the reality of the industry.
The early results from 2012's investment cycles are showing us that about 3,500 new companies got investment dollars last year, or 3,500 early stage rounds that went into 3,085 companies. And there's a big fear coming forward this year, as talked about, that there'll be a scarcity of real Series A monies after the startup monies, and that perhaps we'll lose as many as 1,400 companies across the nation this year, just from that group last year. Have you any thoughts on that?
The Series A crunch is something that's widely talked about in venture capital circles and by LPs. And the reality is that, why is that crunch coming? Well, one idea is that some funds moved upstream, right? So they're not doing that earlier round. They're doing the Series B. They're willing to take a lower return, but they're also willing to write a larger check. But they're not willing to roll up their sleeves because maybe that's just not an area that they're passionate about. Then you have funds that perhaps their target raise was 50 million. And because of the financial crisis and a lot of investors that were traditionally investing in limited partnership vehicles and venture funds said, you know what, instead of my allocation being 5 million to venture capital, now it's 2.5. So you end up with venture funds that instead of raising a $50 million fund, raised a $30 million fund. And so your traditional sources of Series A money that they would have reserved for, right, is lessened. And so the reality is also, at some point, you had companies that were funded, and maybe they were able to hunker down and reduce their burn rate, and now they need Series A money. So you have this glut of companies that need it, and you have a scarcity of capital. And that could be another reason why the super angel term was introduced and said, it's not just an angel that we need now, we need a super angel to come in and help out. that, I think, goes back to the earlier point about spending time also nurturing the education and vetting the questions that the investors have, so that they understand why funds need to be a certain size, why the risk is mitigated when you're able to raise a fund of a certain size and able to deploy and reserve capital appropriately.
Questions? Please feel free to go up to the mic if you have any questions as we carry on, so I know there's people
Still awake.
who are intrigued beyond our own conversation. So does that mean there's going to be opportunities this year? You know, if there's 3,000 companies looking for money, and let's presume only 1,600 or roughly half will get that money, does that mean the investor is on the strong side? Or does that mean that there's other issues that we've really got to take into account?
I think there's at least two issues that I can identify. First of all, is there an opportunity? And I would say, yes, you know, whenever there's scarcity of capital, right, you have an opportunity in terms of your shopping ability if you're an investor. But I would caution that with not being overly aggressive with the entrepreneurial community, because ultimately you want this to be something that works for everyone. You want this to be a partnership in such a way that you have the right incentives in place to continue with that management team, be motivated at a very high level. The other reason why you want to caution and mitigate that opportunity or interpret it appropriately is that I think it was Muhammad Ali that used to say, or some renowned boxer that used to say, there's always a bigger guy out there that can beat you up, right? And so if that company ever needs more capital, right, and you need to go and raise another round, if you yourself, you know, took a great deal, right, and weren't able to nurture it to that next round effectively, someone else will come in and apply the same pressure. So the solution is basically disclosure. You know, sit down with the entrepreneur and say, these are the terms of the market, and here's the data to validate that, and here's where this industry is, and so on and so forth, and see if you can match that. The flip side of that is we will have, unfortunately, I think, a lot of roadkill, you know, and there will be a survival of the fittest in terms of a lot of startups for sure.
Probably even more so this year than
Yes.
we've seen in the last couple of years. Even though we thought the economy has been tough then, I think this year is going to be a tough one.
I agree.
Another question.
Could you talk just for a minute about geographically where you're seeing Series A financing coming from? Is there one part of the country that is more geographically active for Series A?
Well, you know, in general, 40 to 45% of venture capital is concentrated in, you know, California, essentially, right? And about 30% or slightly less is concentrated in the 128 corridor, Boston to New York. So statistically, one would presume that you're going to see a lot of that Series A capital there, simply because there's hundreds of firms that are providing capital, right? And over time, these ecosystems develop relationships such that they know who's putting in the seed capital, they know where the Series A capital is coming from. So as far as a concentration pool, that's where I would say it exists. However, you also have to look at funds that have the capacity to do Series A and can go and leave their geography of comfort. And if the deal is, you know, compelling enough, are willing to get on a plane and travel for 2 hours on a plane and go in and make that investment. Series A is tough. It's really typically the first institutional round. And VCs in general have created a comfort zone of the geography of interest that they may have. And so predominantly that's been California and that high part of the Northeast. And so to me, it's a call to action, you know, to have more people have a deeper understanding of the funding cycles and have more capital deployed judiciously in areas that have great ideas, have management talent, and can benefit from the Series A and Series B rounds.
Beto, you're based in El Paso.
I am.
That's not normally the place we think of, forgive us, as a key place for funding companies or funding firms.
That's
Tell us
news
more
to me.
about what's going on.
You know, I love the place that I live. You know, it's really a very unique geography and a very unique culture and great people. And I just counted as a wonderful opportunity to be able to do what I do there. And it has a lot of challenges because it takes three things to really get a company off the ground. It's not just a tech company. It takes money. You need some money. You don't need all the money in the world, just some. You need an idea, a good enough idea. It doesn't have to be the world's best idea, just a good enough idea. But you absolutely need great people, great management talent. If you have two out of those three things, you can attract the third one. So in California, for example, there's money and lots of people that understand startups. So some of these VCs might go out and say, that's a good idea. Or that person right there, that woman has a great patent and great experience. We're going to make her an offer she can't refuse, and she's going to move to California. So if you have two out of those three things, you can attract that third one. Right. And so it's very important to build out the ecosystem. It's very important to invest in those things where we have a lower level of comfort with. There are great ideas in El Paso and in my backyard, just as there are here. There are pools of capital or significant capital in El Paso, historical capital, and much of it has made money over courses of time in very traditional industries. What we have lacked historically has been a cultural shift in our appetite for risk and our ability to really take on that startup challenge and bring it to the next level. And I'll share this with you. There's funds that I know of that make seed stage investments and do early stage investments. And the profile of failure for those seed stage investments, right? Even though they're smaller bets and they'll make more of those smaller bets, the mortality rate, it's high. And it's high because at some point, that seed stage deal still needs talent. And so the bottleneck is not money and it's not ideas, but it's management expertise at various stages of the company.
But do you think being in an area like El Paso or in some other parts of the country that because it's not the Silicon Valley or it's not the Route 128, that there's actually opportunities that others may overlook?
You know, there are opportunities that others overlook, and we've had the opportunity of talking to a lot of venture funds. Some of those have been very large venture funds, and some of them have sufficient expertise and time in market, talking 20, 25 years, that they can go back over their fund lives and look at what deals came from what geography, at what pricing that performed or outperformed. And we have found through discussion, and we have also found statistically from talking to very specific funds that have a lot of data, that certain areas, geographies of the country, not Silicon Valley, not the Northeast, have outperformed in terms of their portfolio. Why is that? Well, I have some thoughts on that. One of them is that you could potentially buy into a company at a more modest valuation. So if you were to compare valuations in the Midwest or Southwest versus California, you'll find that the valuation for what could be on par the same kind of technology company is a little more accessible financially here. The other reason is if you have to recruit someone and they're really sold on the company and the idea and they relocate, they're very hard to move away because these areas are so alluring. They get endeared to the area. And it's also, they don't have 50 other companies that they can go to that next weekend. That happens in Silicon Valley. So I think it's kind of a protectionist mechanism that's already built into the geography, as well as a market pricing issue, if you will.
So perhaps capital efficiency compared along with that ecosystem that becomes very tight?
Absolutely. And by the way, capital efficiency is probably the number one thing that helps a startup survive over long periods of time, right? Because the rule one of a startup is don't run out of money, right?
Right. And another question.
Good evening. I wanted to go back to the topic of geography, because that's been sort of a big contentious point in the United States where 66% of all early stage capital is, as you were talking about, primarily Silicon Valley, New York, and Massachusetts. It seems to be a little bit of a chicken and egg thing because a lot of the money that goes into venture capital is really institutional money from very large pension funds and yet they like to go with the funds that they're on their third, fourth, fifth, sixth funds. So those type of funds are hard to find in a state like Texas. There's been a lot of reports that we're undercapitalized for the number of deals that we have in the state. So do you believe there is a role, and if so, for policy in the state to try to incentivize the venture capital industry? And if so, what ideas do you have in that?
I think there is a role for policy-driven recommendations that have to be attenuated by the realities of the market. And so what do I mean for that? It's not the same to say, this year we're going to designate $50 million to early stage capital in this part of the state. Because who's going to manage that? And so you really need to develop a cadre of qualified and vetted managers that you could say, we're going to deploy $50 million of capital because we know there's the sufficient number of managers that can absorb that capital. They will go and find the startups, and they will go and help ignite the creation of employment in that part of the state. And they will figure out the cluster strategy, and they will figure out this aspect of it. So there is a role for policy, and perhaps that role begins with a deeper understanding of the industry itself and the asset class, which is very long term. And so the cautionary aspect of policy is that if we have elections every 2 years or every 4 years, and we want to measure something that really needs to be measured over 14 years, we can enact policy that we review midstream in 2 years or 4 years and expect it to give us the results that are really meant to be much longer term. So there is a role, and I do think it has to be attenuated by that. With respect to the large institutionals that make investments, I would say that a lot of these are apolitical in some respect because they're essentially trying to get a return on their investment. There's some that might have geographic or even cultural or other parameters, and I would say even to those, it has to apply in terms of the realities of the market.
Sometimes we don't really qualify the issues of policymakers with moneymakers. We tend to get them sometimes confused, and perhaps we might also think that we need policymakers to put economic development tools in our hands, but the free market should really look at the capitalistic side of these things. I think when either side falls into the other group, occasionally that's when we kind of have problems. Following on, though, to the money might be available for funds in Texas, it may be surprising to you all to know there's over $200 billion managed from within 6 miles of where we're sitting here. $200 billion. And we don't think about that. So in that respect, do we need to educate some of these institutions more about early stage capital and looking at their allocations? Or do you think that that's not the case? And I put this in this proposition in that if you are looking for funds 3, 4s and above as an institution, which is normal, that in more nascent capital areas, that takes quite a while.
Yeah.
I mean, that's a 15 to 20 year cycle, or
right.
At least 10. So, to build that industry, do we need to educate some of these institutions more?
I think some of these institutions have spent time grappling with that because it's a big challenge even for them to do asset allocation. It's just difficult. I think UTEMCO or others like that. It's hard for them to deploy $5 million into a fund because of the sheer time it takes to essentially manage all of those relationships. At the same time, a lot of these institutions, even TRS, right, teachers retirement, right? They have spent some time trying to nurture what they deemed an emerging manager program as a way to say we want to incentivize new managers. We know it's their first fund. We have a criteria, but we essentially want to incentivize over periods of time the creation of new pools of capital that we can deploy money in. So again, it's the size of the fund, it's the experience of the manager, and it's their ability to be in business over long periods of time that's important, which is coincidentally a lot of the criteria that I've begged, borrowed, and steal from these large institutions. And so is there a role that it can play in terms of interactivity and maybe some managers saying, look, this is important and whatnot? Yes, and how you attack that is a difficult question. And for example, there's a National Venture Capital Association, and then up until the end of last year, there was the National Seed Venture Capital Association, which now merged with another organization. So one would think that in the absence of ways to deploy capital into smaller funds and emerging managers, that the National Seed Venture Capital Association would have grown, but instead it did not, right? So I guess the full response is a little bit above my pay grade, but it's something I worry about, because the reality is that if you believe there's this barbell effect of small funds on this side and not too many of them, and large funds, not too many of them, but big, and I forget the statistics, but something like 80% of the venture capital raised last year was raised by like a handful, I'm talking 8 to 10 funds. That is a ridiculous outcome. So are they, in essence, not to say they don't add value, but in essence, are they money-raising machines? Or are they just a safe bet for large institutions? It begs the question. So something needs to happen because we are cutting our nose to spite our face. We're not investing early, which nurtures the development of a proper pipeline, so we don't have a Series A crunch, but we have a better opportunity to have a steady stream, if you will, of opportunities to vet and invest in.
And roughly last year, across the country, about $28 billion was raised.
Wow.
As you said, a large amount going to those large funds. Final question for tonight. How do you view Texas relative to the venture capital market, the health for entrepreneurs, the opportunities to invest early? How do you just view things?
Well, I do have my boots on, and I believe in Texas. This is a phenomenally dynamic state. I was just in Lubbock, and I have the opportunity to go to a lot of areas of the state that one would traditionally not think there's a lot of activity there, because we think of them based on their most dominant industry. So I view Texas as a tremendous opportunity, and that opportunity needs to be captured by the interested parties of each specific area of the state. And what I mean by that is it's not typical, because our state is so big and varied, that someone from Austin will easily get into a plane and go to McAllen, or someone from El Paso might go to Dallas or Houston, and so on and so forth. Just as it's as foreign, if you will, for someone from California to travel all the way across and do the same thing. We have geographic barriers to overcome, not that they're impossible, but the reality is there are some perceptual issues that need to be unified in the state. Now, from a policy perspective, I think the state has attempted, and in some ways very successfully, to do that. Case in point is the Emerging Technology Fund, the creation of regional centers of innovation, the ability to have local people vet deals, bring them up to the state and create an opportunity for investment. I mean, I believe that's a good step. But the reality is that we need more access to capital and more organized pools of capital by vetted managers that can, they themselves, be the bridge, right, to other parts of the state. And what it takes there is really the ability to have fluidity of capital and have a vetting mechanism where if something's in Lubbock or McAllen or Houston or Dallas or Austin or El Paso, it can bubble up to the benefit of the state as a whole. Because if one part of the state loses, the entire state loses. It's not a zero-sum game in terms of moving it from one part of the state to the other. The whole state loses because you lose a part of that ecosystem. So I really view it as, in many respects, a part of an ecosystem, a subsystem by region, but it forms part of a bigger lung. And I think we're better off, as part of that bigger lung and understanding how each part contributes to it.
So going forward, we're going to get stronger?
I think so. I mean, and that's my optimistic side, speaking. But I think you only get stronger by really having an active participation in how that happens. And it starts locally and it bubbles up statewide.
I think that's a great call to arms and end for this evening. Please join me in thanking our fabulous speaker, Dr. Pallares. And we will have a reception outside.